In this presentation, we are going to acquaint ourselves with the concept of income tax return, the due dates of filing income tax return, the various forms in which income tax return should be filed, and the various types of income tax return. To start with, let us acquaint ourselves with the concept of ITR. ITR basically is a special type of information or a special type of form which is required to be filed by an assessee with the income tax authority, where information related to total income and tax liability along with particulars such as name, address, permanent account number, bank account, etc. are to be shared. Such return is to be filed in any of the forms which are prescribed as per Rule 12 of the Income Tax Rules 1962. Which of the forms are to be chosen, or which of the forms are to be filled in for filing of income tax return depends on the component of total income, the tax liability, and certain other parameters. Now we move on to a few instances where filing of income tax return is compulsory. By virtue of section 139 subsection 1, these are few instances where filing of income tax return cannot be done away with. For example, in case of a company or a firm or a local authority having any amount of income or loss, filing of ITR is compulsory. Same is the case for any ordinarily resident, that is ROR, who is not required to file return as per the second criteria, which we will come to, but those RORs who are having any asset or any financial investment during the relevant previous year outside India, or signing authority in any account outside India. That is to say, any bank account which is held overseas. For individual assessees or Hindu undivided families or AOP BOIs or any artificial juridical person, if the gross total income before providing for exemptions under section 1038, 10A, 10B and 10BA exceeds the basic exemption limit, filing of an income tax return becomes customary. For example, individuals having below 60 years of age are subject to a basic exemption limit of rupees 2,50,000. So if their gross total income before providing any exemption under section 1038, 10A, 10B or 10BA exceeds rupees 2,50,000, such individual shall be compulsorily required to file ITR as per section 139 subsection 1. Next we come to the due date for filing of return of income as per section 139 subsection 1. This basically depends on the type of assessee. For assessees who are having international transactions or specified domestic transactions as specified under section 92E, the due date for submission of ITR shall be 30th November. For example, for assessment year 2017-18, the due date shall be 30th November 2017. In case of any company other than those covered under section 92E or any assessee who are subject to compulsory audit of books of accounts or the working partner of any firm subject to compulsory audit, the due date for submission of ITR is 30th September of the relevant assessment year. For example, for assessment year 2017-18, the due date is 30th September 2017. For any other assessee, for example, individuals, Hindu undivided families, etc., the due date for submission of ITR is 31st of July. That is, for assessment year 2017-18, the due date shall be 31st July 2017. Next we come to income tax return forms, the different form numbers in which income tax return can be filed. The choice of form shall depend on the type of income and the type of assessee. For individual assessees who are having salary income, that is salaried individuals who may have family pension, may have house property income from only one house property but does not have any brought forward house property loss, and income from other sources not including casual income such as winnings from lottery, crossword puzzles, card games, etc., and no losses under the head income from other sources, the form number shall be ITR 1, which is also known as Sahaj. For individuals or HUFs who are not having any income from PGBP but who are not falling under the category of ITR 1 shall be filing their income tax returns in ITR 2. For example, if any individual has house property income from two house properties or more than that, or if they are having brought forward house property losses, or if they are having casual income but not having any proprietary business income, they will be filing their income tax return in form number ITR 2. Now, what about individuals who are having proprietary business income? For incomes or Hindu undivided families who are not covered by any of the above cases, and those who have proprietary business income or professional income, not those incomes which are subject to presumptive taxation, they can file their returns in form number ITR 3. Now, for presumptive taxation cases covered by section 44AD, 44ADA or 44AE, these are special cases where income is not taxed as per the slab rates or as per the normal income tax provisions but as per turnover, a certain fixed percentage of turnover, and presumptive taxation scheme is basically for small assessees. So for those assessees who opt for presumptive taxation, they should always file their income tax returns in ITR 4. This form is also known as Sugam. Now coming to firms, association of persons, body of individuals, local authorities or any other artificial juridical person, they are required to file their income tax returns as per form number ITR 5. Companies who are not claiming an exemption under section 11 are required to file their ITR in form number ITR 6. Lastly, ITR verification form, which is generated after the successful completion of ITR filing, is generated in form number ITR V. So this was all about ITR forms. The due dates and ITR forms are to be remembered religiously for the purposes of examination. Now we are coming to the different categories or the different types of ITR. We have already seen the normal category of ITR, which is covered by section 139 subsection 1. Now we are coming to the other types of income tax return. The first of which is return of loss, which is covered by section 139 subsection 3 of the Income Tax Act. This is applicable for assessees who have sustained losses under the head profits and gains from business or profession, or capital gains, or losses from the activity of owning and maintaining racehorses. For these type of assessees, the return of loss is to be filed within the due date as per section 139(1), as we have already seen. In case of companies or compulsory audit cases, it is 30th of September. In case of individuals and other assessees, it is 31st of July. Or in case the assessee is having specified domestic transactions or international transactions as specified in section 92E, the due date is 30th November. Now, what happens if return of loss is not filed? If return of loss is not filed, then carry forward and set off of losses from in the nature of business losses, speculative or non-speculative, or professional losses, or losses from specified businesses under section 35 AD, or capital losses, or losses from the activity of owning and maintaining resources cannot be done. Next, we come to the concept of belated return. As the name suggests, this is basically the type of return which is applicable to assessees who have defaulted in filing their income tax returns within the due date. For belated return filing, the time limit is before completion of assessment year. That is to say, for assessment year 2017-18, the time limit is 31st March 2018. If belated return is filed, the assessee will be subject to interest under section 234A. If belated return is not filed within the time limit, that is within the completion of the assessment year, that is say for assessment year 2017-18, if the return is not filed within 31st March 2018, penalty of rupees 5,000 shall be imposed under section 271F. Moreover, if belated return is filed, losses which are specified under section 139(3), which we have already seen, that is return of loss, such as business losses, losses from the activity of owning and maintaining resources, capital losses, cannot be carried forward unless this thing is condoned or foregone by the Central Board of Direct Taxes. We now come to the concept of revision of return. A revised return is required to be filed when the assessee has already filed a return under section 139 subsection 1 or a belated return under section 139 subsection 4, and the assessee subsequently discovers the fact of any error or omission in such return. Now, the time limit for filing of a revision of return is the earlier of 1 year from the date of end of assessment year or the date of completion of assessment. For example, if For assessment year 2017-18, the assessment is completed on 30th June 2018. The date ending 1 year from the end of assessment year is 31st March 2019. So obviously in this case, the date of completion of assessment being 30th June 2018 shall be taken as the last date for revision of return. Lastly, we come to the concept of defective return under section 139 subsection 9. An income tax return is regarded as defective by the assessing officer if the annexures, statements and columns in the income tax return filed relating to the computation of income under each head of income or the gross total income or the total income have not duly been filled in by the assessee. The assessing officer, upon the discovery of any defect, will intimate the fact to the assessee, and the assessee shall be given an opportunity to rectify such defect within a period of 15 days starting from the date on which the intimation was given by the assessing officer. If the assessee fails to rectify the defect within the time limit of 15 days, such return shall be invalidated. However, invalidation may not be done if the assessing officer, on his discretion, chooses to do so. If the assessing officer condones the case and does not invalidate the return upon delay, it will still remain a valid return. The consequences of an invalid return are the same as failure in filing an ITR within the due date. That's all about income tax return.